Hey, hello, welcome everybody to today's workshop. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. And I wanted to come chat with you today about pulling back the curtain on some of the most hidden aspects of the financial industry. And the most hidden aspect I find is, how much you're actually going to pay, right? So there's don't get me wrong, there's plenty of great firms out there and they are full disclosure and everything like that. But the majority, to be honest, are not. So give everybody a second to check in here. First of all, hope you're having a wonderful weekend. Here in California, they have opened up the beaches. So we went to the beach yesterday. So if I look a little burnt, I got too much sun. I didn't put on any sunscreen, but it was a beautiful, beautiful day out. The wife and I ended up staying there. I think we got there about noon or so, and we ended up staying till about 7:30. So really, really beautiful day. So, it was interesting. Apparently have this lockdown order. There's people everywhere that were just stationary. So there were people moving, but a lot of stationary people. The lifeguards were making announcements but they were kind of making announcements almost as like something they had to do. There was like zero enforcement going on of really anything. So, hopefully it actually felt normal, so all these people talking about their new normal and all that. There was people walking around with masks, but in general, most people were separated. The families were kind of together, not a lot of interaction, some football and things like that. But overall, it was a beautiful day. So it's good to see, it just feels really good to get back to normal and to see that, yes, we've been locked down for a few months, but hopefully our whole summer is not going to be spent inside because it's just too beautiful outside. So looks like everyone is getting in. Yeah, Rebecca, I should use sunscreen. I know. I didn't think we'd be out there that long. It was just such a nice day. We had lunch, and then we were just hanging out. Went and explored, and then before you knew it, was time for dinner, and we were just out there for too long. So, good point though. So today, I want to jump in, and I want to talk to you about something that in my personal world, right? So I think you guys might know. I run a financial planning firm. It's a registered investment advisor called Keep It Simple Financial Planning. So we are in the business of full disclosure when it comes to fees, but a lot of the majority actually of firms aren't. So I want to talk to you about how do we get paid, and then I want to talk to you about the industry as a whole and how that works. So that at the end of the day, like I think today, I'm just going to put myself in my consumer advocate seat. And I'm just going to, kind of expose everything, so that you guys can make good decisions, right? So that's what I want to do today is just give you the insight of really, some of you might know the reason why I do what I do today is because my parents were taken advantage of by, someone calling themselves a financial advisor, but in reality was not a fiduciary, was not working in the best interest, and basically just sold a bunch of products, right? So I have a little bit of a, you could say, chip on your shoulder. It's not really a vendetta. I think overall most people are good, but I think the incentive structure matters. And when you have the wrong incentive structure, then that's going to incite improper human behavior, right? So I'll dig into more about what that means. But along the way, I would actually love if you have any questions, put them in the chat. Okay, put them in the chat, and so that I can answer those towards the end because I kind of come from my own internal perspective, right? And the way I communicate is what I'm doing my best to communicate to you in a way that makes it so simple that you shouldn't hopefully have any confusion. But at the end of the day, I'm just a human as well. And being on the inside, sometimes, I can assume things that maybe you don't know. So feel free, please put your questions or comments in the chat. And so that I can get to those at the end to make sure that you leave today with a very clear understanding of how to arm yourself, right? Because I really do think the consumer is still in a disadvantaged seat when it comes to, the financial world in a sense. And it's really unfortunate because a good financial advisor is like indispensable. You would be amazed, and I don't say this to brag, but you'd be amazed at the amount of savings or the amount, when it comes to tax savings, investment returns, optimization of things like Social Security and pensions. I mean, it's been many, many times 6 figures or more, and many times tens of thousands of dollars that we're putting directly in the client's pockets by the recommendations that we make. So I truly believe in the power of a good financial advisor. But I still think the world, the financial advice world in itself is still highly conflicted. And we'll talk a little bit about that today and sort of what's going on. So again, if there's anything you want to ask about that I'm not clear on, please let me know. Okay, so where do we start? Okay, where do we start? So I'm going to let's bring this up here. Okay, let's bring this up. Okay, all right. So I want to break this down to as simple a form as I can. Okay, so compensation models for financial advisors. When it comes down to it, there's really three models. Okay, so you have commission. Okay, so commission. This is going to be the majority of the big firms. Okay, they're going to be heavily commission based. So when you're looking at firms like Edward Jones, Ameriprise, ones like the smaller ones, you see like these Primerica, World Financial Group, those type of firms, they're heavily commission based. Okay, so when you have commission, you're going to make a commission off a product that's sold. Again, I'm going to dig into this a little bit. Okay, and then we have fee based. Fee-based. So the industry has moved a lot of away from commission and more towards fee-based. Okay, so what fee-based really means is, they get paid fees for certain things, but they also get commissions. So they also get commissions on products that they sell. Okay, so this gets a little tricky. So again, I need to spend some time. So please bear with me as I kind of dive into this. I want to kind of start high level, and then I want to go deeper on some of this stuff. And then there is what's called fee only. Okay. Okay. So fee only is where you pay. Actually, there's really three ways to pay, but you're essentially paying some sort of flat, disclosed in black and white fee for the advice or investment management service that you receive. Okay. So that's what we are, but I'm gonna get into this in just a moment. Okay, so commission. So what does commission look like? So people get mad at me sometimes, but I love Dave Ramsey. I respect Dave Ramsey. I think his plan, 7-step baby steps overall are good. I think getting out of debt and having a plan is good, but I really have a problem when it comes to the investing advice that he gives, because the majority of the people he recommends work for companies that are primarily commission, right? So when he says, paying a commission up front on a mutual fund is better than paying like a 1% ongoing fee because you make your money back over time, theoretically that would make sense. But what you have to remember is there's still ongoing fees that come along with that. So what happens with commissions, you're usually looking at a couple things here. So you usually have mutual fund sales. Okay, let me make this a little thinner because I think it's kind of hard to see. Let me make this a little thinner. Let me go to this here. Okay, so mutual fund sales. So mutual fund sales are basically when you go in and you want advice, and essentially the advisor says, you don't pay me anything. I get paid from the company. Okay, and so what's going to happen is generally you're going to pay something like a 5.75% commission. Okay, so you're going to pay a 5.75 commission on the front end of your investments. So this is, generally not the best way. Okay, this is probably like one of the worst ways in a sense to get your financial advice, because if you're going to start nearly 6% down and you got to make that up, it's going to take you a long time to make that up. Dave Ramsey's point is like over 20 or 30 years that you'll probably come out ahead if you were to take this model versus like the assets under management model, which again, like I said, give me some time to kind of get into these things, but I'll break this down. But the problem with that is when you're dealing with these type of mutual funds that are charging 5.75% commission fees, they generally still have a 1% fund fee. Okay. So if you were to look at what's called your prospectus, okay, or honestly, you can just pull up your statement, and on your statement, there's going to be something called a ticker symbol, and the ticker symbol is going to be anywhere usually from 3 to 5 letters of some sort. So, for example, one I just know offhand is called VTI, right? So the Vanguard Total Market Index. That's one you could type in, but yours are going to all have different ones. It might say MBO. It might say VEO. Whatever. It could say a bunch of different things, VEA. But when you type that into Google, it'll actually pull up the fees right there so that you can see the fees that are going on inside your account. So Dave Ramsey's argument is that it's better to pay the upfront commission of 5.75 instead of an ongoing fee because you'll make it up over time. But the problem is many of these funds actually have fees for about 1%, all the way up to 2%, of fees inside of these mutual funds. So that can be, actually a lot more expensive because, you're still paying the internal cost over time. And the thing is, you don't really see that fee. And so to you think, oh, I just paid my upfront fee and, now I'm just investing over time. Well, in reality, if you were to actually go under the hood and look at that mutual fund and see what you're being charged, that is, you probably find out you're probably paying somewhere between 1% to 2% of fees all in, right? So there's going to be fees like the mutual fund fee. There's something else called a 12B1 fee. 12B1 fee, and that's like a trailing fee sometimes in there. So if you see your fund, it'll say like, growth fund, fund A, right? So you see A. My writing is just so sloppy. Excuse that. So, growth fund, and you see an A at the end, okay? When you see an A at the end, that means you have an A share, okay? So that generally means you paid commission up front, okay? So you probably paid the 5.75 up front, and then there's, some sort of ongoing fee within the fund. And sometimes the fund fees are low. American Funds is a company that's famous for this. If your balances are low, the fee is going to be a lot higher. And as your balances get higher, let's say 500,000, or to $1 million or more, then that fund will decrease over time. So if you have a large account, sometimes it can be okay because your fees all in, aren't that bad. But the problem is paying that 5.75 up front. Imagine if you this year, 2020, paid that in January, right? And then I think it was February 18th, the market took a 35% dip or 30% dip at that point. You now have to not only come back what the market came back, you have to come back an additional, nearly 6% on top of that. So that's something, I'm not a big fan of, okay? Commission world. Other things you might pay commissions on, so you gotta have mutual funds, and then you have annuities. Okay, so annuities are another way that financial advisors can do business, and I should mention, financial advisors, the term, there's apparently some regulation coming out, but it's not clear yet. Generally, it's not really a regulated term. So anybody can call themselves a financial advisor. So, an insurance person can call themselves a financial advisor. A fiduciary can call themselves a financial advisor. Someone who does kind of a mix of different types of products can call themselves financial advisors. You could be, I've even seen people that are like, real estate brokers call themselves financial advisors. So kind of a general term. So, it's not really a great way to figure out who to work with. But mutual fund sales are one way, commissions, those type of advisors work. Annuities are another way. And then you have, other insurance products, right? So insurance products, could be things like annuities, like I mentioned. They could be long-term care insurance. They could be, like cash value policies, things like that. So when you're working with an advisor that is commission-based, they're going to make a fee, generally from the company on the back end of whatever product you buy. Okay, so this is something you may not be aware of as well. I'm going to bring up an article in a second, but the CFP board. So the CFP stands for Certified Financial Planner. Okay, so I personally am a certified financial planner. Actually, the standard is very high. Like education was pretty hard. Like it was very challenging for me for that test. And keep in mind, like I studied chemistry and chemical engineering in college, and that was harder, obviously, than engineering classes. But the Certified Financial Planner coursework was very rigorous. The test was very difficult, right? I passed it the first time, thankfully. I have to take that thing again. But I do respect the designation. But recently, the CFP board has taken away compensation model when it comes to searching on their site. So I really don't actually send people to their site anymore to find an advisor. I send them to other places, which I'm gonna kind of share with you in a minute. But I want to kind of finish this commission conversation. So the commission advisors are generally going to sell mutual funds, make a commission up front. They're going to sell things like annuities or insurance products. They can still give you financial advice on other areas, right? But it gets quite confusing because they're not really held to the same standard as somebody who works in a fee-only space and then sometimes in the fee-based space. Okay, so commission advisors operate under what's called a suitability standard. Okay, so suitability is basically the recommendation just has to be suitable, right? It doesn't. There's a very wide standard. I don't think there's very few legal cases that have ever been won when a recommendation was made by a suitability type advisor. The other side of that is a fiduciary. Okay, so fiduciary is where the advisor is legally bound to do what's in your best interest before their own interest, and so this is why I recommend fiduciary. Okay, again, we're going to dig into some of this a little bit more. So that's commission. Okay. So let me make some space here. Let's talk about fee-based. Fee-based. Okay. So fee-based is probably what most of you that are working with advisors that are with some of the bigger companies, like if you're working with something like LPL, Merrill Lynch, those type of companies, they're generally fee-based. So you can be a registered investment advisor and also be fee-based. So what fee-based means is you're going to get fees on things like managing assets, for example. So if you're if a fee-based advisor is managing assets for a client, they might make a 1% fee on average, sometimes higher, 1.5 or 2 up to 2.5 in certain cases. But they can make that fee there. But then they can also sell you insurance or annuity products and make a commission off of that. Okay, so when you have suitability, I don't know if I'm spelling this right. Suitability or suitability, I forget. Anyways, but versus fiduciary, suitability is going to be a much lower standard, like I said. So fee-based advisors essentially get to wear two hats. Okay. So when they are advising you on things like retirement accounts, so like your IRA, your 401k, they are required to operate under a fiduciary standard. Okay, so that's why fee-based is considered better than commission, right? But if that same advisor says, hey, well, you should put 30 or 50 or 60% of your money into an annuity, or you should buy my hybrid long-term care insurance policy, or you should buy this whole life insurance policy or universal life. Whenever they're selling you a product like that, anything that's a transaction based like that, they're going to operate under the suitability standard, which lowers the standard of advice and care that you are required to be treated with, as a consumer. Okay, but when they give you advice around the IRA, well, now they have to operate under that fiduciary standard and give you advice that's in your best interest. So the problem is, it sounds good, right? So fee-based sounds good, and it actually is very confusing with fee only. But it sounds good, but the problem is in the same conversation, right? Because I don't think, I hardly ever have one conversation where we only talk about investments and then one conversation when we only talk about, insurance when I'm talking with a new client. Generally, we're going to be talking about a comprehensive financial plan where we're going to talk about things like insurance, taxes, investments, estate planning, long-term care, whatever it may be. A lot of things that are going to be coming up in a conversation. So if you can have, in the same conversation, be jumping back and forth between, suitability and fiduciary, the problem is most of the people I really think are good people. Okay, I really do think most of these folks that are operating in this space are good people, and they just are required to sell certain products, by their companies. And excuse me, there's a new, a best interest standard coming out that they're trying to confuse you, right? As a consumer, they're trying to confuse you with best interest and fiduciary, because a fiduciary has to do what's in your best interest first before their own, but then they have this best interest standard, but that's not really a fiduciary standard. So this is, as a consumer, it's really confusing. It's actually a big lawsuit going on right now, actually multiple lawsuits going on right now, because as a consumer, when you work with somebody who has conflict of interest, it can get really challenging for you to really know what's in your best recommendation. And here's the thing, is like, like I said, I'm gonna get to fee only, but we're fee only, so we don't make any commissions anywhere. We just charge a fee for advice, or a fee for managing assets. But do I recommend annuities sometimes to people? Yes, because I think they are a good fit for certain people. But the majority of folks probably don't need them. And the problem is like annuities, they pay a lot of money, and what a lot of advisors will do, and these are especially kind of the chicken dinner advisors, I call them. When you get those mass mailings that come to your mailbox and says, "Come join us for a free chicken dinner," or maybe it's a fancy one, maybe it's a steak dinner, right? Maybe it's upscale area. But these are the folks that a lot of times their main goal is to get you to buy a product, okay? Because if they sell you an annuity, a lot of times the commission is going to be somewhere between 6 to 10% of whatever the amount is that you put in to that annuity, okay? So if you have, $100,000 annuity, well, let's call it let's do a bigger number. Let's say it's a $1 million annuity. And this advisor gets a 6% commission. What is 6% of $100,000? 60 grand. So, that's a highly tempting commission when your job is to put food on the table for your family. And you can have, somebody that says, "Hey, I'm very low risk. I don't want to lose any money. And so, I really want to keep my money safe, and I'm okay earning 2% or something like that." Then annuity is where a lot of people go. I don't really agree with that in a sense, because annuities, when you have this much, and again, depending on your portfolio. So let's say this was your whole portfolio, okay? Let's say you put your whole portfolio into an annuity. You're going to get that, that payout somewhere between 2, 3, or 4% generally per year. And you will limit the downside risk. But the problem is, long term, you're not going to have enough money growing for you, because inflation, is a real thing. And if you have everything and you're only getting paid out 2 or 3% or 4% the first year, maybe it's a little higher, might be 5%. But then that never increases over time. That's going to leave you with the money you think is a good amount of money today is not going to be, not going to have the same spending power in 20 or 30 years towards the end of retirement. So, when you have somebody that is trying to put the majority of your money in the annuity because they make this commission, that could be a big conflict of interest, right? And so, and at the same time, maybe they split it up, right? Maybe they do, $500,000 in annuity, and then, they manage $500,000, at a 1% fee. That's a way to do it too. But the problem is you're kind of getting hit in both areas, and you don't really know as a client exactly what you're getting paid. And if you are working with somebody that is offering you an annuity, I would highly recommend you say, "Show me how much you're going to get paid in writing." Okay. If they're a fiduciary, right? Because people are saying that they're fee-based and that they're fiduciaries. If they're fiduciaries, they should have no problem at all putting in writing what they're going to be charging you and what their commission is going to be for this whatever product that they sell you, right? Because that'd be the fiduciary thing to do, wouldn't it? If you're a real fiduciary and you're legally bound to do what's in the best interest of your client first, don't you think you should be, telling, if someone asks you, "What are you getting paid?" If you start hearing, I get, nothing, and they start saying things like, "Oh, well, the insurance company takes care of me," or "the mutual fund takes care of me," or "the annuity company takes care of me." It's not true, guys. Not true, okay? Because what's going to happen is you're going to buy this annuity, and you're going to have what's called a surrender period, okay? And surrender periods are generally somewhere from 7 to, I think, 11 years is kind of the highest I've seen. But that means your money for 7 to 11 years is locked up in this product, okay? And if you wanted to take the money out early, what's going to happen? You're going to have a surrender charge, and that surrender charge is going to be basically what the commission was and went to the advisor. So if you try to surrender the annuity in a year or two, you could look at your surrender fee, it'll probably say 10% on your contract, right? Over the years, that surrender fee goes down, but that's because the company's had time to take the money, reinvest it, and earn more than what they've paid out to the commissions. And that's kind of the idea with annuities, is they can take the money, invest it at a higher rate, pay you out your 2, 3, 4, 5%. Their goal is to make 7, 8, 9, 10, 12, and then everyone's happy apparently. So the problem with with fee-based is you have an advisor wearing two hats. Okay, so partial fiduciary, partial suitability. Okay, so let's see. I don't see any questions yet on this. Okay, I don't see any questions yet on this. Okay, so I do see some questions which I'll get to, but those aren't in here yet. Okay, so now we talked about commission, and we talked about fee-based. Okay, now we have fee only. So fee only is in my opinion, okay, my opinion, and actually most most financial people's opinion, and I can show you some articles here, but most people's opinion, fee only is the best way to do business. Okay, the lie that's told is that, well, we need to keep the commission model around because there's some people that can't access fee only advisors because their fees are too high or their minimums were too high, right? Because you might have seen like some people have a $500,000 minimum or $1 million minimum, and that's true. There are a lot of places that have that, and that's definitely the case. But there are plenty of people that don't require a certain level of assets to work with, right? So fee only breaks down to three categories, okay? So you're going to have the one probably most people are familiar with, right? So assets under management. Okay, assets under management. So that's essentially where you move your money from, let's say your 401k, because most people want to move their money from a 401k to an IRA after they leave their workplace because they have more investment options, right? Or maybe the plan's a lot less expensive. But so you move your money to your advisor, and the advisor is going to charge you a fee of generally somewhere between, I don't know, the average you see is kind of 1% to 2.5%. This is kind of the average. Some people are lower, and you don't usually see much higher, but I see a lot that are mostly in that 1.5% range, 1.25 to 2%, a lot in that range. So some of the bigger companies, definitely that call themselves fiduciary and fee-based are going to be this high. So this is kind of what most people are familiar with. What's a reasonable fee for assets under management? I think 1% is a reasonable fee. That's pretty normal. We charge 1%. This is us. Keep it simple. So we charge 1% up to 600,000, and then after 600,000, it goes to 0.7%, up to 2 million, and then after 2 million, it's 0.5%. Okay, so here's the dirty secret of the industry. It's not a lot more work to manage more money, but it's a lot more responsibility and a lot higher risk, right? So we had the fee model the regulators prefer is this assets under management model because it just it's real simple and it's fair. Everyone gets the same rate basically, in a sense. This most people, again, 1% fee, that's probably pretty reasonable. So if you're paying under this model and you're paying over 1%, depending on the services you're getting, right? Depending on the services you're getting. But, ideally you want to be around 1% or less. Okay, that's kind of the goal there. Okay, so that's assets under management. Then the next option is flat fee. Okay, so flat fee is where you basically pay like a project fee in a sense. And so you're just going to pay a flat fee for a financial plan. Or you might pay a flat annual fee for ongoing financial planning services, right? So flat fee is really great for people that want to manage their own money. So if you want to manage your own money, a flat fee is the way to go. The challenge is, from what I've seen, is a lot of people want to manage their own money, but then many people just don't do a great job. And so providing an extra value between things like tax loss harvesting, investment selection, proper rebalancing, it's not that difficult to make up an additional 0.5 to 1.5%. Of what a typical client would do that's not really paying attention to their account. So again, maybe you're good at that and you want to manage your own money, then that's fine. So flat fee is kind of the primary model that we use because we do a lot of financial plans, right? I think everybody needs a financial plan. Not everybody's going to need assets under management. Assets under management is good once you have certain amounts of money, but if you're below in the neighborhood of, one or $200,000, you should just probably put that in something, really simple, right? Something like a target date fund or a simple 3-fund portfolio. Google three fund portfolio. That'd be a simple way to do it. Once you start getting above 400,000, 500,000, and then beyond $1 million and plus, there's other things that come into play. And there's a lot more, that you need to pay attention to when it comes to properly managing your wealth for the long term. But, flat fee is a great way where you just basically, you pay a project fee for a financial plan or ongoing services. So, that's, one fee for service. For advice. Okay, so flat fee is another great way to do business. This is how, again, we start with a lot of clients. You'll see a wide range of fees of what it costs to work with somebody to get a comprehensive financial plan. But the average range for the most recent research that I've seen, and there's people that go cheaper, by the way, okay? But cheaper is not always better. There's some people that'll just plug some things into software and call it a financial plan, and that's what most banks do this. Most of the large companies do this. They don't really give you like a highly detailed plan, because if you want a really detailed plan and you have to dig into things like tax planning, distribution planning, Social Security timing, pension selection, there's a lot that goes into this stuff to putting all those pieces together. So you really want to make sure that you are working with somebody that is going to get that, really, high level of depth when it comes to your financial plan. But when you have like a flat fee service, so this is what we do with most of our clients that come in. We usually start everybody with a financial plan, right? So what you're going to see here is probably somewhere in the neighborhood of $2,500 to $10,000 for this, okay? Our average fee, again, I'm just putting this on the table today because I want you to be an educated consumer, and I'm just going to put it out there, right? So full disclosure, because you can look this stuff up anyways, by the way. You can look up what almost anybody charges if by just Googling hard enough. But our average fee is somewhere in the neighborhood of $3,500 to $5,000. That's kind of our average fee. But we don't just do a general retirement plan, right? We do things like portfolio recommendations, tax planning, distribution planning, Roth conversion a lot of things that go into this. Insurance, we're going to talk about insurance. We'll make recommendations for you for long-term care, for life insurance, for disability, all those type of things. We'll make sure you have the right estate planning documents in place. So we do comprehensive planning, right? So that's somewhere where, our fee is somewhere in this range. We're not the cheapest, but we're not the most expensive. But I think the caliber of advice you're going to get, because we have, 2 CFPs on my team. I'm also a chartered retirement planning counselor, and Craig's on my team as well. He has like 9 designations. So, we're going to go much deeper than just a general financial plan. So this is kind of where we're at. But again, just being full disclosure here, this is what you're looking at. So assets under management is one model. Second model, flat fee for fee only. And then the third model is hourly. Okay. So hourly, you're going to see a big range here as well, right? Most of the time, you're going to see somewhere, the cheapest I really see is $75 per hour, and then, up to $500 per hour. Okay, so a lot of people want hourly, from what I find, but in reality, it's usually, it might be more expensive unless you just want one issue dealt with. So our fees for hourly is generally, anywhere $200 to $300. But we don't really offer this as a one-time. What we normally do is something like we do a flat fee first because this is the best bet. We're going to spend somewhere in the neighborhood of 8 to 20 hours, sometimes even more on a financial plan. And so I think it's better to do somewhere in this range and just do a one-time fee versus charging you, let's say $300 an hour. If we get to 20 hours, then you're at $6,000. That's just, not really that great a way to do business. So this is the third way, though. So some people just do hourly, and hourly can be great for certain situations. The problem is when you do hourly is you're only going to get advice that's targeted on one issue, right? Or 2 issues maybe. And the thing is, I think when you're working with an advisor, you really need somebody to go through the whole scenario first, right? Go through the whole scenario first. So the assets under management or the flat fee are going to get you the comprehensive advice generally that you need to make sure that you have the whole plan. But the problem here sometimes is with assets under management, the majority of advisors don't want to do things like talk about taxes, They won't help you with that. They won't make recommendations on your 401k. They won't do things like that. They won't look at any sort of outside accounts. Right? So this is why I like to start here with flat fee. And then I think the assets under management is a great way to work together on long term, right? So I think that is a really good way to do business there. But industry wise, if you're paying above 1%, if you're paying like 1.25 or 1.5, okay, that's a little bit on the high side. If you're paying more than that, if you're getting towards a 2 to 2.25, that's really high, right? That's really, really high. So that's probably too high. So you probably want to stay more towards this 1% range. And if you're looking for somebody to do some flat fee planning with you, then somewhere in the range is what you're gonna be looking at here, 2,500 to 10,000. So let me take a pause here and talk about some questions. Let me take this off the screen for a second. Let's go back here and talk about some questions. Okay. Let's see here. Okay, so this is a good question. Let me take this stuff off here. All right, so your thoughts on rolling some of my work 401k or Roth into an annuity to diversify portfolio? If a good idea, what is an acceptable commission to do this? So, David, here's something interesting. You don't have to pay a commission, right, to do this. I would actually, if you want to do this, I would actually recommend that you work with a fee-only advisor that could give you advice and help you find a product that their personal commission is not attached to, right? Because that's something like, again, not trying to say to work with us or not work with us, right? But there's plenty of fee-only advisors like we are, and you really want to look for registered investment advisors that can and will make a recommendation on an annuity, but they won't necessarily make a commission off of that. The great thing about that is you're really going to remove that conflict of interest, and you're going to find somebody that can help you find the best product fit for you. The hard part is it's really difficult to find somebody that actually understands and knows about annuities and doesn't make a commission off it, right? So you want to look for a fee-only advisor that specializes in retirement planning to help you out with this stuff, because that way you're not really going to have to worry about it. If you want to work with somebody that's going to get paid a commission, like I said, you're not going to have a choice really. Like you're going to get paid. They're going to get paid somewhere between 6 to 10%, or whatever that amount you get put over is. So if you find someone, let's say that's an hourly advisor, and maybe they'll charge you, maybe it's $200 an hour, and maybe they say, it's going to be 3 hours for us to spend some time with you, get to learn your situation, and then make a recommendation for an annuity product if that's something you want to do. That might cost you $600, and if they charge you $300 an hour, that might cost you $900, right? But there are fee-only products that are annuities that basically remove the commissions out, which means you either pay less for the product internally or you get a better return or a better payout on your annuity. And those are the ones that I like, because if I'm taking the fee out for you, you're going to get a better product overall. And so that is definitely something that's available, hard to find again, but definitely available. So if you're going to pay a commission, you're not going to see it probably. If you ask them to disclose it, that's great if they do. But if you hear somebody say that I don't get paid anything, the insurance company takes care of me, that's something you probably want to run from. That is not fiduciary. That is somebody who is a suitability category, and you should probably not work with that particular person, in my opinion, right? Not saying they're not a nice person, not saying they don't mean the best, but most of these companies hire people that don't really know any different. And so they hire these people, and then you have these products that are sold in-house, and if you're going to get it from, I don't know, let's say Ameriprise, right? Well, if you work in an Ameriprise advisor, they're only going to be able to offer you Ameriprise annuities, right? If you work with someone that's independent, like Keep It Simple, we have the whole field, right? And actually, I have an annuity specialist that's, again, these folks work on salary, and you can get annuities that are commission free, and so that means more payout to you. So if you're going to pay a commission, it's going to be 6 to 10%. Just be aware of that. But I would recommend, if you can, find somebody who is a fiduciary that can help you find the right product for you, the right product fit that matches your needs, right? Because everyone's a little bit different when it comes to their needs. Okay. And then on that note, you want to stick with generally simpler products. There's a lot of really fancy products when it comes to annuities, but some of just the immediate annuities, the fixed annuities, they could be a good way to diversify your portfolio instead of bonds. Nothing wrong with that. but you don't want to put too much. 10, 20, 30% is kind of the max, I would say. But once you start getting to 60, 70%, it's just a lot, and you're going to lock that money in. With interest rates being so low right now, it's really kind of a tough thing. So I am a fan of things like short-term annuities. So if you want to buy an annuity, let's say for like 5 years, for example, right? To guarantee income for 5 years or 3 years or 7 years, whatever it is. Something like that to just fill a short gap until you hit Social Security. So let's say you were 62 and you were going to delay Social Security until 67, and you wanted to make sure you had guaranteed money there for 5 years. Annuity could be in a good fit there. But single premium immediate annuities or deferred income annuities, those could be good. There's something else called a qualified longevity annuity contract, I believe it's QLAC. But those are usually bought inside of IRAs, and they have a limit of, I think, $125,000 or $150,000. But the idea for those is that those kick in at like 80, 85 to make sure you don't run out of money on the back end. So those can be a good tool for that kind of long-term planning. So, the problem is, David, is when you're working with somebody that the way they get paid, right, is by commission. It's really tough. You're dealing with a big conflict of interest. Like if they can sell you two products, if they're looking at two products, one's a little bit better for you, but the other one pays a much bigger commission. What do you think the advisor is going to choose, right? I mean, it's just tough, and either one's going to be suitable for you, so they're going to be clear on the suitability standard. So, again, this is why I recommend everybody works a fee only because it's just clean. You're going to pay out of pocket a little bit, but it's a clean relationship, and you are working with somebody that is their goal is to give you the best advice possible. And I do recommend certified financial planners as well, but you want to get a fee only one, okay? So hopefully I answered your question, David. Let's see what else we got here. Okay. Tamara asked, what is a CRPC? Chartered Retirement Planning Counselor. I have that as well. So I'm a certified financial planner, which is CFP, and then there's a CRPC, which is Chartered Retirement Planning Counselor, and that is specialized in retirement. So that was a good class to learn more, good designation, I should say, to learn more about retirement planning. It's not a class, it's multiple classes. Let's see here. Okay, so what if a fee only recommends an annuity? Does he or she get the commission? Pat, no, there's no commission to be made, right? So if it's a fee only, that means they cannot accept commissions, right? So that is the thing where it's like, if you are wanting somebody that's fee only to recommend something for you, get ready to just pay a fee for their advice. So pay their hourly charge or whatever flat fee they're going to charge for you to make this recommendation, but they cannot get paid. Right, so that's why they are fee only, because the only fees they get paid are from you, from the client, directly from the client, all in black and white. Very clean business model. So the answer is no to that question. Let's see what else we got here. Okay. Okay, so this is a good question. What is the minimum amount in investments to have a fee only advisor? So this is a great question, Malia. So the minimum amount is 0. Okay. If you want to have an assets under management relationship, remember I told you about the 3: assets under management, flat fee, or hourly. Assets under management is going to require a minimum, right? Generally. So most people it's like the minimum is usually like 50 or 100,000. That's kind of the lowest. But there's plenty of flat fee or hourly advisors that will charge you either like kind of an annual fee. If you work with them, they'll charge you that quarterly, monthly, whatever it may be. We offer that service. Or they'll charge you kind of a one-time flat fee planning service, something like that. And so as we get into this, I'm going to share with you some networks that I recommend for you to search. Again, obviously, we're here to help you, but if you want, I'll share with you where to go of networks that I trust, and I think there's a lot of good people there for you. Okay, so the answer to that is 0. Okay, so Tanu, I really hope I'm pronouncing your name right. Tanu is asking, fee only is on assets worth or the profit made. Actually, it could be both. There are some advisors that work based on the profits that they make for you. I generally recommend against that, because then you're talking about people that are trying to time the market, and timing the market is generally a losing strategy. It's like 98% failure rate. And so, you really want someone who's just going to do percent on the assets that they're actually managing for you, right? So not on your whole net worth. So maybe you have a house that's worth $1 million and you have a $1 million, investment account. They're not going to charge you on the house and the assets. They'll charge you on the assets, alone. So hope that answers your question. Let's see here. Okay, so Dana asked, usually the fee only is on assets worth at the end of the quarter. So generally, when I say 1%, that's a good question. Let me clarify that. So let's go back here for a second. Okay, so assets under management. Assets under management, AUM. Okay, so if you have a 1% fee, so that's going to be 1% per year. Okay, so that means per quarter, it's 0.25%. Okay, so most firms bill in arrears, which means the end of the quarter. Okay, end of quarter. So the reason why I like this is because you're not going to get billed anything up front. Once the quarter closes, you'll get billed 25% of the annual fee. But ideally, your advisor has invested well for you and has done more than made up their fee during that quarter versus what you could do yourself. The problem is when you do the commission and you do on 5.75 up front, you're just going to get, you're just getting killed, just getting killed here. I don't like this at all. Because if you're paying 6% upfront and then you're still going to pay the ongoing management fee, which most of them charge, and it's usually internal in the fees, it's a really expensive way to do business. So, I hope that answers that question. But that's good. Yeah, and it's assets worth. Some people bill on the assets on average daily balance or sometimes end of the quarter. It just kind of depends on the advisor style. That should be all disclosed to you in your paperwork there. Let's see here. Okay, so if a fee-only advisor manages a portfolio, do they only invest in no-load funds to be considered no commission? How does a fee advisor avoid commissions by using no-load funds? Yes, generally. Yeah, so almost, I don't even know. I don't know anybody that does loaded funds and charges asset management fee. That's what happens in some of the big companies. So that's how fee-only advisors do avoid that, right? So we use no-loaded funds. So generally ETFs, no-load mutual funds, that's kind of the normal. And so that's, the answer to your question. But yeah, loaded funds are just not the way to go. Back in the 80s and 90s, loaded funds were like all there was, right? That's kind of how you did business. But as things evolved and we've come across things like index funds, index ETFs, and really, low-cost mutual funds, loaded funds are just not really a necessity, and there's basically zero that outperform, the low-cost funds over time. So there's just no reason to do loaded funds. I just would stay away from it completely. So if that answers that question, let's see here. So with flat fee, do you assist with outside accounts, such as Fidelity 401k? Yes. So some will and some won't. So here's a challenge: is some advisors will advise on outside accounts and some won't. The problem with the advising on outside accounts is that, as a fiduciary, we are required, to have, ongoing monitoring of accounts, right? So if you are managing your 401k outside, then potentially you can make a bunch of changes along the way, right? So, does everybody advise on outside accounts? No, because a lot of people will want people to move the money over to them so they can manage it for the fee, but we personally do. We'll advise you on allocation. We want to make sure allocation matches with the rest of your portfolio, but you'd have to make your trades and those type of things, when it comes to actually managing the accounts. So, but yes, let's see what else we got here. Some good questions. This is some good questions here. I like this. And if this is helpful to you, let me know in the comments that you're enjoying this type of Q&A, because I want to make sure it is valuable to you. Okay, so if a fee, I already answered this one. Let me skip this. Sorry. Okay. So where I struggle with is with the markets being down. If I move my funds to you to manage, won't I be locking my losses? Well, no, not necessarily. If the markets go up in between the process of the transfer, then that's a possibility. But there is something that you can do called an ACAT transfer. You basically just transfer the exact funds over. And so then you can always sell them once you transfer them over and then rebalance the accounts and into whatever you're going to invest in. So then there'd be no locking in losses of any sort. So, that's just if you were to sell and then basically leave everything in cash or something. But no, there'd be no locking in of losses. So, that's a no. Right. So Tanu, this is basically, Tanu's asking what are load funds. These are funds that have commissions, Tanu, simply. So there's, A shares, B shares, and C shares. It's where there's a commission paid out to the advisor, generally on the front or the back, or sometimes along the way each year. So just look up loaded funds on Google, and there's a lot more detail. That's going to be beyond the scope of this particular workshop today, but I did have talked about it many times in the past if you want to search through the trainings. Let's see here. Cool. So those are all the questions I'm seeing. Okay, so if you want to discuss your particular situation, we do offer complimentary consultations. Okay, so I'm going to put the link down below in the comments. But actually, let me take a step back. Are there any questions about commission, fee and commission, or flat fee or fee only? Commission, fee and commission, or flat or fee only? I want to go back to that. Make sure there's no questions about that, because it's really, really, really important that you guys get this. Important for your long-term future. So let's go back to this for a second. So just as a summary, okay. 3 types: commission, okay, we got what that is. Fee-based and fee only. If someone says they're fee-based and they're fiduciary, remember there's 2 hats, okay? There's a fee hat and then there's a commission hat. So when they're selling products, they're not a fiduciary. When they are advising on retirement accounts, they are supposed to act like a fiduciary. But there's so much crossover, I just don't think it's worth the risk for you. And then there's fee only, where you either pay a flat fee by assets under management, flat fee for the like a project, or hourly for advice. Those kind of the 3 ways. So this is what I recommend. So where do you find these type of advisors? Okay, I've already plugged myself. Okay, and I'm gonna share with you some. And this is full disclosure. I am a member of some of these networks. So I do, and I'm not a member of other ones. So I do want to be full disclosure that I'm a member of a couple of these networks and not members of other ones. So where do you find a fee-only advisor? Oops. Fee-only fiduciaries. And where I'm going to recommend for you, these are fiduciary advisors. Okay. So you can have fiduciary advisors that are fee-based, like I said, and they'll call themselves fiduciary. And actually, let me talk about a couple of articles here. Before we jump to that, let me talk about a couple of articles here, because I think this is good stuff. Oops, didn't want to quit. Okay, so let me share this here with you. Let's go to. Where's my? There we go. Okay, so let's talk about this a little bit. Okay, so I want to share this article with you. So if you guys don't know, like I said, I am a certified financial planner. Okay, certified financial planners overall are great, and they're a great way, for you to work with somebody. The problem is that recently the CFP board has changed the way that they're allowing you to search for advisor. Right. So previously, when you go to the CFP board's website, they used to let you choose how to search for an advisor, how they get paid by either flat fee, commission, or a combination of both, right? So this was very confusing, and what we believe, again, who knows, we don't know, but we think this was done by lobbying by insurance companies that want to create that confusion for you as an investor of what the difference between fee-based and fee-only is, right? So I actually recommend you go to the CFP website to find this out. So like it says here, previously consumers were able to filter results in the group based on how they got paid. Okay, but fee-only planners are fiduciaries at all time. Means when they make recommendations, they charge a flat fee for financial advice that stays the same regardless of mutual fund or annuity they recommend. So this is exactly what I was just explaining to you a moment ago. But on the other hand, brokers who earn commissions are beholden to a less rigorous advice standard. Right, so it can be more financially advantageous to work with a broker when you're planning to buy a stock and hold for the long term. That could be a good way to do it. But this has caused a big uproar in our industry because I believe that more disclosure is better than less. So for me, more disclosure is better, right? So I think you as a consumer should be able to search by fee model, by background, by experience, on all those type of things. The CFP board thinks that they're saying that all CFPs need to act as fiduciaries, and theoretically, I agree with what they're saying. Okay, theoretically, I agree with what they're saying. and I see where they're coming from. And I see why they're trying to move the standard to fiduciary for everybody. But the problem is it's not a real fiduciary standard in my opinion. Because you can work for some of these large companies, and there's companies that have products that are definitely not the best product out there. There's definitely better options for you. But since that's the only product that company offers, that's still going to meet the fiduciary standard of the CFP board. So not good, right? So it's really just not really what I would typically recommend. So a couple other things here. Let's talk about these things. This is an article here by Michael Kitces. Okay, so if you don't know Michael Kitces, he's kind of one of the big influencers in the financial advice industry. And he has an article here, which you can Google, that says why Series 7 brokers can't legally be client fiduciaries without a fiduciary rule, which did not pass. This is an older article from 2017, but the best interest standard, like I mentioned, is not a fiduciary standard, so it's a problem. So if somebody has a Series 7 license, which is what you need to make commissions, then it says here they can't legally be fiduciaries. And as you read the article here, it says here the key issue is that when you are operating under this standard, the licensee is acting as a representative of the broker, right? So when you're acting as a representative of the broker, so anytime you deal with a broker, the broker technically has an obligation to serve the broker and not the client, right? So if somebody has an obligation to serve the broker and not the client, and that's in their contract, that's in the writing of what they're obligated to under their employer, then how can they be a fiduciary, right? So this is when you come to the fee-based advisors. This is why I have a problem with the two hats, because they can say they're fiduciary technically, but in reality, at any time they can switch that hat. And so, again, I do think paying for advice is the way to go. Let's see. One other thing I wanted to show you. And then the other thing I'll show you here quickly is this article here. So what's happening now is that states are creating their own fiduciary rules, right? Because what's with that regulation BI, regulation best interest that I told you is what's out right now. A lot of states, like I think Massachusetts, New Jersey, I believe, and Nevada, are all going to come out with their own fiduciary rule because they don't think that the best interest standard is good enough, and it's not a real fiduciary perspective. So, again, I really hope that this was beneficial for you. If you want to chat with us, I'm going to put my link to my calendar page in the comments, but you can go to keepitsimplefinancial.com/talk. And if you want to go there, then that will take you to my calendar page. If you want to talk with me personally, I'll be happy to chat with you, and I'll be happy to actually look over what you have as well. By the way, so if you have someone you're working with that you're not sure if they're fiduciary, if you're not sure if they're doing the right things for you, I'm happy to do a complimentary review of what you have, and we can discuss what's good and what's bad about what you currently have, and if something better, it might be better for you. But on our call, we're going to spend about 45 minutes talking about your current retirement situation, what's on your mind. What you're facing, then we're going to talk about where you want to go, and then we'll talk about, what's going to take to get you there. And if it's something I think you could use our help with, then I'll definitely let you know. But if not, that's okay too, right? So we call this our retirement strategy call. It's complimentary, like I said. I can't say free. It is free, but free just sounds kind of cheesy. So it's a complimentary call for you, and I'll put my link down in the comments here. So once again, that's keepitsimplefinancial.com/talk, and see if I can put this up here. I don't know if I have this ready. Yeah, I can't have it ready today, but I'll put it in the comments. So if you guys have any other questions, leave them in the comments. I'll get to them. I hope you found this beneficial. And if you have any follow-up questions later, if things come up, feel free to just send a comment, send me a message or whatever it may be, or send me an email. I'd be happy to chat with you. But regardless if you work with us or not, oh shoot, I've totally forgot about this. Oh my gosh, I'm gonna keep you one more minute, guys. I apologize. I told you I was gonna tell you where to find a fiduciary, right? Okay, So we are fiduciary. You don't want to work with us because you don't like me, you don't like the way I do things, that's fine. Okay, then you're going to go a couple places. NAPFA.org. Okay, NAPFA.org, I'm a member of this organization. This is all fee-only advisors. So National Association of Personal Financial Advisors. Great organization, really, really solid people there. Definitely recommend that. Okay, another one I'm a member of as well, XYPN. Okay, and I think it's .com. Not sure. But XYPN, That's a wide range. So if you're younger, 30s, 40s, 50s, XYPN has a lot of advisors that specialize in working with younger people. So if you are somebody that doesn't have like $500,000 or $1 million saved, and you want to pay for hourly or maybe like a flat fee, XYPN can be a great resource for you as well, because there's people there that work with lower assets, but also people that are they're both members, right? So I'm a member of both. So I'm a member of NAPA and XYPN. So those can be good. Some of the advisors there do offer hourly as well, but not the majority. If you go to Garrett Planning Network, this is one I'm not a member of. Garrett Planning Network is mostly hourly, right? So if you just want hourly advice, you might want to go there. And then another one is ACP. I used to be a member of ACP. I just was paying so many fees and memberships. I dropped the membership. So ACP, I think it's .org, I think. But again, these are all fee-only fiduciary advisors. So all of these are real fiduciaries, real fee-only advisors. So to make it into these networks, they do look at your disclosure documents. They do look at how you get paid. So these are great places to find an advisor. If you want to chat with me, like I said, keep it simple. Financial.com/talk. Okay. Oh, my screen's in the way, aren't I? /talk. Okay. So if you want to chat with me, keep it simple. Financial.com/talk. That's so ugly. I'm going to take this off here. My writing is horrible. So sorry about that. But if you want to chat with me personally, that's where you can schedule a call. Put it in the comments. I hope you found this useful. I hope you found this beneficial. Leave any questions, comments you have for later. I'll get back to them. Have a great Sunday, and keep yourself safe out there. Keep as much money as you can in your pocket. Only work with fiduciary advisors, and make sure you have a plan, okay? Everybody needs, at a minimum, of a plan for retirement. And if you need help with investments and things like that, that's great, but I think everybody should get a professional for their plan, all right? Have a great day, folks. We'll talk to you soon, and have a nice weekend. Bye-bye now.